just after 10 o'clock in Honolulu, 4 o'clock in New York on Thursday, last day of October, the 31st, 2013. And this is the daily report for gold and silver. We have the precious metals as a whole under dramatic pressure. Currently, we are looking at gold trading off about $19 on the day. $13.2390 is the current print. The low is $18.50. The high, $41.20. Quite a range today. We'll talk about that. We'll talk about the fact that it hit the upper band of our resistance line and just kind of popped down, all on today's daily report. Let's look at silver. Silver also having a tough time today, down almost 80 cents on the day, $21.93, the low $21.70, the high $22.56. Japanese average chart, but you can see it is below, it's broken below this critical support level that we deemed at, call it 22.25. When we remove the study, the Japanese average is a study, you're going to get a much more realistic picture. And you can see without a question of a doubt how this market has just barreled through this particular support area, as I said, at 22.25. 360-minute chart, same chart we used at the beginning of the show. I've just compressed it. And the reason to compress it is to really illustrate just how effective this resistance line has been, one, in really illustrating where potential tops are in the market and giving us a real strong indication of when this market's not only going to get top heavy, but the point of resistance that it obviously cannot make it through, because this is not the first time that it is stalled here. This is more like the second time, just in, call it the last couple of months. Now, we'll look at this fall from a lot of different vantage points. For right now, as we just did with silver, I want you to see the real effect of what we saw in the market today. Continuous contract COMEX gold, we'll look at the spot market to see if we see this kind of gap. Now, realize that you do have the low coming into this point, so it is not a true gap. But nonetheless, we have had a fall from grace today. That is the least we can say about this market. Now, really, the most important question that we can ask ourselves at this point is, where could this market fall to? Has it found support? If so, where does that support come from? To do that, looking at a much shorter term, 240-minute chart, we have our basic resistance trend line in place already. We also have one fib retracement. The fib retracement that we're looking at, we put in yesterday. It runs from the start of this last rally, 1251, up to 1362. When we do that, 23%, 36, we could see, and we talked about this yesterday a little bit, but it looked as though there could be some sort of support in this area. We had a couple of lows that came in, but not really that much. Market barrels pretty much straight through. We'll convert this to a standard chart so we get a better indication, but you can see it's a 23, so it is just up off this. This is 319.90, so call it 1320. 1320 does have a little bit of historical reference to it, not too much, but you can see this band that was formerly put it at a resistance point. In other words, as this marketplace traded higher, it found its real level of resistance right below this. And I think we were pegging support at that point at 1300 to 1306. That would have been based on this 50% retracement as one of the studies. But obviously, it looks as though this is the first point. We'll see if it's going to hold 1320. If it cannot, 1306, 61% retracement, and this seems to be the most likely, and I'll explain why in a second. If the market continues under pressure, we could see a dip to this area. One of the reasons that my eye is drawn to it is you can see all this kind of static in here, all of this trading range that was developed as a bottom was forming. The market comes up, but really clusters in this area. This is that 1275 area. My sense is that 1300 should hold, first of all. If it does not hold, the next level we really want to look at is going to be, I'll call it 1294, and that, of course, is based on this Fibonacci retracement study. Now, realistically, we have been given a tremendous amount of information on this last dip down, and let me explain what I mean by that. As we looked at this market, and I'm just drawing this in relative, obviously, but we talked about the fact that we had a series of lower highs. We also talked about the fact that when the market hit this low, and this is the 1181, and it came up, the fact that it stalled right here and broke through, told us that without a question of a doubt, we're still within a bear market, meaning this entire downtrend that we have been experiencing and witnessing for the better part of a year and a half, almost 2 years at this point. However, market comes back down and it makes a higher low. We also pegged this low off of a specific retracement of this move up. All of that was in line, so that realize at any point this market can go from a bear count to a bull count. But to do that, we have to see a significant shift in market perception and the way traders are placing their bets, so to speak. So when the market failed to take this out a second time, meaning just right now in terms of our historical data, that tells us the following. It tells us that this market is probably in wave 5. When we take a look at the big picture, what we're looking at is wave 1, wave 2, long wave 3, counter wave 4, and final wave 5. Now, final wave 5 as a flat would take us back to 1181. As a truncated would take us above that. It could terminate anywhere and switch back into a bullish market. That would be a truncated, or what's called a standard zigzag. And a standard zigzag would actually mean that the low of 5 in a traditional Elliott wave count, the low of wave 5 is going to be below the low of wave 3. Just as the low of wave 1 is above wave 3 is going to be above wave 5 in a traditional count. That tells me that we could see some real pressure in the market. We could see this market continue to the downside. But once again, we'll have to see, because I've been in scenarios where the market will pretty much fake you out by hitting a certain point, moving down, but then just kind of clipping back up. Do I think that's likely right now? Not really. Not the way that the traders have been playing this, especially now that these commitment of traders reports have kind of caught up. We got the last one yesterday, and what it showed us more than anything else, and there is a link on the members page to go to the most current reports, is that managed money is overwhelmingly short this market. I think it was 16,000 contracts to 200 contracts. Some unbelievable number where almost all of it was set, and this is managed money, this is speculative money, not hedge money, but the predominant majority was spread to the short side of the fence. Now, we're looking at a daily chart, and if you recall, I believe it was a couple of days ago, we talked about this most recent low, and this is that low at, about 1250, and how it really matched up in terms of having historical data or historical reference in which we could say, okay, when it was at this point, this is what it did. Because realize, resistance and support are part and parcel of the same thing. It's whether or not you're on the second floor looking down, or on the first floor looking up. That structure, that floor or ceiling, is the same structure. In other words, ceiling, floor, support and resistance is the same thing. The one thing we want to realize is that in between this point, when we look historically, there is really almost a void or an absence, because this is when the market went parabolic. Not parabolic like this record top, but look at this tremendous rally, almost a straight up rally from 1150 up to about 1300. Comes down just a little bit, and I'll never forget this, because this was that period of triple tops that we had towards the end of 2010, and it threw a lot of traders off. Then, of course, this comes down. This is February right in here. This is where Soros begins to buy. So we have some historical evidence and data in the price point of 1400, 1300, but there is fairly, in terms of a technical basis, again, not fundamental, but technical basis, there's an absence or a void of any type of area to look for. Now, there is this one particular bottom if the market continues down, and I have a feeling that's going to be roughly at around that 1293, that one point we have already identified as a potential support level right below 1306 and 1319. Now, one of the things that we looked at right at the beginning of the show was how that longer level resistance line, and that's the resistance line where we had a failure, of course, right in here as this resistance line came down, and I'm not really sure what the angle was, but we also had a failure here. When we look at a couple of the fib retracements, so you do have 1365, that is a number that comes in. It's a 50% retracement, and if I am correct, it is a 50% retracement of this move from, call it C to C here, right here, this one wave. And that would be a 50% move of this rally here. No doubt when we look at this, it just kind of clustered to the top and fell apart. Market is moving lower. 1313, 76% retracement. So those are the numbers we really want to watch. 1306, 1313, 1331, it has broken through, and that was a pretty critical area for us. Now, what about silver? Silver has had a dramatic fall. Honestly, I thought that it would probably hold up a little bit better, but with the kind of pressure that gold has been under, we are absolutely seeing it in silver. Silver being the winner in terms of the percentage loss or percentage drawdown in terms of what the value has given up on this daily chart. You can see this long red candle. I put in a fib retracement from 18 to 25, this long rally here. When we do that, 2074, critical level of support, it has not even gone near there. The real level we want to watch right now has got to be 2160. 2156 is a 50% retracement. We talked about this one critical area. It has clearly fallen through there, and so the next real level that it could go to would be the 2160. Now, we did have a stop. I believe it was 2182. We had a low well below that today. So effectively, we did get knocked out of silver, pulled a profit in our gold. We took a loss in our silver trade when this market came down. I guess the one good thing is I have had multiple emails that were sent to me over the last few days where most or many of the traders that emailed me did exit the silver trade when they exited the gold trade at about a push. In terms of support right now in silver, the one place that I will peg it at is going to be just above 21 at 2162. You can also see that that is pretty much where our low fell to today. We'll have to see how this market kind of unfolds as the dust settles, so to speak, and see if there's continuing downside pressure or if the market can find some support. My sense right now is I would lean more towards the downside pressure, but let's see what happens when the dust settles. This has been Gary Wagner, wishing you as always good trading. Talk to you tomorrow on Friday for the weekly wrap-up and review. Bye-bye.